Hi everyone, hope you're doing well. Today I have a special guest. Today we are joined by HInvest or Henry. Henry, how are you doing?
I'm doing very well, Jacob. Lovely to see you, and thanks for having me on. I'm very excited to discuss stocks and shares with you because I'm very fond of your channel. I know we've been watching each other's videos, and it's great to finally meet and get a discussion going.
Great stuff. Henry, I've got to say, I found your YouTube channel and we've been talking for offline for a bit here before doing this live video. But I found your channel around about a year ago, maybe. And I remember going on this YouTube channel of yours and I can't remember the stock I was looking at. And I was playing your video for a few minutes and I was like, oh my days, he's a UK investor here. And I was listening to it and he's a really good investor, really good content. And I'm scrolling down and then I saw, I don't know what subs you were on now, but I remember seeing 1,000 subscribers and I was thinking, no way, this guy's going to be massive in the next few years on YouTube. And when a few more people find his YouTube channel, so honestly, it's great to have you on.
That's very kind of you to say. And I discovered JKR, Jacob's YouTube channel. Before that, I discovered it in December 2023. This was when the whole dark trade situation was going on. Cybersecurity, great industry to invest in. And I mean, Jacob covers the UK market like nobody else. I know it's great that we got two British investors on here this morning, but I admit that I don't have actually almost any UK stocks. I don't have any public stock investments in the UK right now. But at that time, I was interested in dark trade. That's how I found his channel. And I've been dipping in and out of it ever since, actually. And I noticed that we're often just on the same wavelength with what stocks are on our watch list. We have some large holdings are actually very, very common and some that we don't. So today we're going to give you a really good overview of some thoughts on our minds, and very excited to get this started.
Oh, that's kind of you. I'll send you that Bitcoin later on. Hopefully by the end of this video, I'll get you into maybe one UK stock and that'll be a success.
You know what? Yeah, pitch it to me. I'll be quite interested because there's no reason why I wouldn't. It's just, and this actually like leads us into the first segment quite well. It's just I am a bit of a sucker for top line growth. There are many ways to invest in the stock market. Like, you know, I know technical traders that make a lot of money. You can make a lot of money value investing. Granted, the stocks are a bit less volatile, but if you find a stock trading at $40 a share with an 8% yield, you know, and then you sell it like a year later for 60, or if you just trade it up and down, you can make a lot of money doing that. But that's the thing about the UK market is I'm a bit of a sucker for, like, revenue growth is my first port of call for a quantitative filter. And the UK just doesn't have that many quality names in its in the FTSE for that.
Yeah, 100%. And every time we seem to get that one gem of a UK stock, we're not getting great value over here, so we're going to switch across to that American market. Or we have some other company that goes, oh, really interesting, that small UK business, and look at the valuation of that. We'll just pay double the valuation and take it over. And it'd be like, oh, that trace, here we go.
Finbra Bravo was an American private equity, right?
Yeah.
They were bought out by Finbra Bravo. Yeah.
So I guess that moves us on quite nicely to the first topic, which is the thought process for picking stocks. I mean, you kind of touched on it a bit there about being more growth orientated. Have you got any principles like you've got to be top digit growth or anything like that? What's the thinking on your checklist?
So this is my source. Is, you know, the basis of thinking about it is like, if you're doing what we do, you really want to be beating the index and beating the index by a decent margin. Because if I compounded my money at 11%, even after taxes, you're looking at the S&P's 10. You know, the S&P has done 10 since if you measure it from the 1920s or the 1950s or whatever, it's usually like a 9-10% CAGR. You've obviously got the Nasdaq 100, QQQ ETF, that does even higher. So that's where this sort of like obsession with growth comes from. And as I said, you can make money in other ways, but the whole idea is the revenue growth is the prime engine. You know, if a company hasn't got good long run sustained revenue growth, eventually things are going to dry up, right? And all the best companies, you see this pattern of having incredibly sustained revenue growth for an incredibly long time. That's what Amazon, Netflix, Nvidia, all the best performers of all time, they've had revenue growth over a long period of time. So the whole idea with looking at least 15% is that, if I was looking at a company that had 5% revenue growth, there would have to be a lot of either margin expansion or the valuation multiples would need to increase in order for that price action to go up and return more than 10% a year, thus like beating the indexes. So I actually try to look at revenue growth of more than 20%. I cut that a bit of slack, particularly if the company's larger. So I'm talking like more than 100 billion. So Jacob and we both have large holdings in Alphabet, and I cut that some slack on like the growth rate just because it's such a huge company, and then valuation plays into that as well. Uber's a large holding of mine that's growing less than 20%, but again the valuation's cheap and they've got some qualitative catalysts that have not shown up in the numbers. But yeah, if it's a young company, I really like to see that growth. And you look at when you compare most companies that have done really well over the long term and compare them against the S&P, most of that alpha versus the S&P when they were a smaller company. So I really like to see those smaller companies with more than 20% revenue growth. The idea is they capture the opportunity, they keep growing, they optimize their margins, they maybe get into an index like the Nasdaq 100, and then Wall Street's like, oh, and then you sort of get like a few years of steady price action. So that's really the basis of my process. Yeah, smaller cap preferred, but I've got a lot of large caps right now. I think you have to in this industry in this like phase that we're in right now. It's also just important to really see the business care about its customers. That's the bottom line. Like you can do rent seeking or you can do all these clever tricks to like try to squeeze money out of people, but eventually you're going to damage your reputation and drive the company into the ground. So you want to find a business that's really making their customers' lives easier, and also the kind of products that you would either say if it's more of an enterprise product, you want to go to the CEO and be like, hey, this is really helping our department. Let's get it in the whole company. Or as a consumer product, think about like Spotify, for example, Netflix. You're telling all your friends about it. You're like, you have to do this. Like SoFi makes banking in the States so much easier. No more automated clearinghouses. Let's like tell everyone about it and have this. Oh, everything's in one app. Great. So that's that. Top management teams really, really important, because that's the captain of the ship. And yeah, just the top business quality, right? Like the economics have to work, the opportunity has to work. That's basically my point. And if you can get a business that's growing well, also at the right price, you think about a business where if the revenue growth 3x's, which if it's growing at 20% CAGR, it'll be a 3x in about 5 years. Plus, if there's a 3x uplift in valuation, so price to sales goes from 5 to 15, multiply those two together, then you've got your 9x return. So that's really how you can get multi-bag of stocks, growth companies at the right price. How about you, Jacob? Which one of those do you look at most?
Yeah, I was just going to say on your point there, 100%. I think a lot of people don't appreciate a management team. Honestly, can make or break your investments. So many times I've been in stocks thinking this is 100% going to work out, and then management team will go make a decision, and you're thinking, you know what they're playing at, and then I don't know, something like overpaying for an acquisition or some sort of expansion internationally, then it ends up eating all your profitability. At the end of the day, these are the people that are running your business, making all the big decisions. So it's important to have a good management team, and that's a key point. I think I like founder-led companies if you can, as well, founders that have still a big stake in the business, because it's also in their best interest as well then for the business to be successful, which is funny enough leads to one stock that interested me was Hims and Hers at the time, because the founder then, Andrew Dunham, he had originally a big stake in the business, and both a stock that we've been interested in, and that what's led me to buy Hims and Hers originally. Yeah, but from a stock point of view, pretty flexible, really. I don't mind buying value stocks, don't mind buying dividend stocks, growth stocks. The only thing with growth stocks is, and I'm not particularly buying growth stocks at the moment, is I don't tend to like buying growth stocks at 52-week highs, just because sometimes the valuation makes me nervous. So I'm a bigger value of growth stocks when they're in a crash, if I can. The only growth stocks that really interested me at the moment are dLocal and New Holdings. They seem to be still okay valuations. I don't know if that's just because of the area that they operate in with the Latin America America space at the moment. But yeah, I'm buying more value stocks at the moment. I'll be honest with you, I quite like buying falling knives, and sometimes I can get my hands quite bloody doing that. But as long as I've got the conviction, sometimes I do keep going lower. But as long as I've got the conviction and I'm confident they'll work out, then I do like buying fallen knives, and sometimes it can turn out to be pretty good performers. I remember buying Hims and Hers, and that was a $10 stock, and thought that was a decent opportunity, and then it fell down to $6, and I was thinking, right, it's not going any lower than that, and then the market just continued to send it down to $3, and obviously we know that one kind of worked out. And I remember like SoFi for as well, that was a $10 stock, and then the market just kept sending that down lower to like $6. But overall, yeah, like a total mixture of stocks, value stocks, growth stocks, dividend stocks.
I mean, that's a good place to be because I agree. Like now we're at the point where I don't think we're quite in sort of 2021 levels in terms of expensiveness, but as the market gets more expensive, you do have to be very agile in that regard because yeah, you can be an expert in volatile growth companies that grow 20%, but of course they'll get hit the hardest when the market
Yeah.
falls. So you've obviously got to play that. Interesting points. The one thing I'll say is like I'm in a friend's house at the moment, and they built their own house 4 years ago, and I just kind of came up with this analogy with regards to founders because I've also run an Airbnb, right? And then people can kind of like trash the place. And the Airbnb is like when you have a short-term management team that come in, they've not got any equity in the stock or in the Airbnb because they're just staying there for a few days. And then you've got like a long-term CEO that might be someone that's bought the house and they live in the house and they take great care of it. But the founders, that's like building a house. That's like building your own house, not just your house, but your dream house where you and your family will want to live for like the rest of time. And you're going to take care of that house like nothing else. And I think that's like a really good analogy. It's like I've never built a massive company, but I've heard a lot of people describe what it's like on various podcasts. It's just like taking care of a baby, or like baby's different, but it's when you build your own house, you'll take care of that way more than a house you're staying in short term, or even probably a house that you've bought, because every single brick has been sort of done to your taste, and you've spent all that time and energy on it. So founders really, really important. Yeah.
Yeah, that's a good point there, isn't it? You're going to make sure you don't take the shortcuts when building your own home, aren't you? You're not going to take any shortcuts on hiring things for short-term benefit, are you? So that point there leads us on quite nicely to the outlook for 2025. Do you think it's a 2021 stock market again, or do you think we're not in a 2021 stock market again? I think from your feeling there, maybe that we're not in a 2021 stock market situation. For me personally, sometimes I do think we're getting a bit bubbly, because then I look at some of these IPOs and I look at the valuations, they go to like 80 times sales, and companies that have no revenue and profit, valued at multi-billion pounds. And then some stocks that I'm sure we're going to get onto a bit later today, some of the growth stocks that you would expect to be crazy valuations if we were in a bubble market. And you've got the likes of growth stocks like Monday.com and Salesforce that are down 40%. So what's your thinking at the moment?
Sure. Sure. Yeah, I think my take on it is the first thing to say is whether like there'll be a crash or not. Of course, there's going to be a crash at some point, and recent history has taught us there's so many wild cards we can't predict, right? I know there are a fair amount of people that said, "Oh, things were getting very hot in 2006, 2007 with the mortgage market," and like that was clearly insane. But obviously, COVID was a complete black swan. There was a suspicion that obviously crashed the market a huge amount in 2020. One of the most intense crashes we've had since World War II was when, yeah, we all thought that Trump was going to announce tariffs. He was protectionist in his first term, but we didn't know that he was going to announce them to the stake that he announced them. And so you have a lot of wild cards, and there's often something like that that crashes the market. That's always the catalyst. But the flip side of that is like, let's say if Trump had come in, let's say late 2022, and had announced those tariffs, would have market had like a few 5% a day drops? Probably not, because it was much cheaper in late 2022. So it's difficult to know exactly what will be the trigger. But I think you've just got to look behind the scenes and say, yeah, like our PE ratio on the S&P is a bit higher than usual. I think it's about 27 or 29 right now.
I was going to ask you about that. Yeah.
Yeah, so there's that. Another thing is that I have particular stocks that I like to look at as a barometer, because obviously there's a lot with that PE ratio. It's kind of hard. You can't really use it in isolation because there's a lot that changes, and it's different because now we've got faster growing companies that make up the bulk of the S&P. So if Nvidia's got a high PE, it's saying the S&P is more expensive. Nvidia now makes up much more weighting of the S&P. So then it's kind of unfair to say, oh yeah, the S&P is more expensive because Nvidia deserves a higher PE than companies that were further up the index, like Walmart was further up the S&P 20 years ago and deserves a much lower PE than Nvidia. So what the other thing I like to do is I like to look at extremely general stocks and have a look at their price to sales, price to earnings relative to the past, see how they're doing. Microsoft and Amazon are a good barometer for that. Amazon, I think you should use more price to sales because their margins are expanding because their high margin businesses are growing more. So AWS obviously fast growing, and their advertising business. Visa and MasterCard are great barometers to look at because that's also overall health spending in the economy. So actually looking at the price to sales of particular things, and also just not owning stocks when they are egregiously overvalued. The Trade Desk comes to mind. Actually, I had a video on the Trade Desk, and that's a pretty good company. But that was extremely expensive to the point where they've had a couple of earnings which were still half decent, and the stock plummeted. Like it plummeted once, it went back up, and then it plummeted again. I think both of them were like 30 to 40% crashes. So when you own a stock that's a bit more depressed in valuation, it'll get less pulled down when you have that macro trigger, and it will also survive better if they have like a tiny revenue miss, a tiny earnings miss. And this is also brings on to another point, is particularly in the US growth stocks that I'm looking at, the trading action after an earnings call is insane. The stocks are always moving double digits, aren't they? But that's great because it creates an opportunity. It's like if it pushes it up to fair value, you can trim. If it crashes, you can double down. And it's like, yeah, sometimes I say, okay, wow, that was bad earnings. And I say, let's reduce the risk here. But most of the time, nothing's really changed about the long-term thesis, but volatility creates opportunity. So the bottom line is to always own good businesses and own them at good prices. But I do think we're definitely more expensive than average in the overall market right now.
So still not 2021, but a little bit of rich evaluation.
I'd say late 2022 was very cheap, and since then, because we've had 2.5 really good years since that period where we were cheap, I'd say probably 7 out of 10 in terms of expensive. But that's obviously not a reason not to invest, and we don't know when the crash will be, right?
Yeah.
We might be in the 1996 version of the dot-com bubble, and it might take another 4 years of, oh, AI is going to take over the world, and then you might miss out on that 4 years of growth.
Yeah. And that's a great thing about being a long-term investor, isn't it? That you don't have to panic about these situations. If we are in 1996 again, then we just sit back and then the returns come in. And if we do get a 2022 situation again and it's like shooting fish in a barrel, then we take those opportunities and we'll go buy them and hopefully have another good year like 2023, 2024, 2025.
Absolutely. Yeah. So if you can get yourself to the point where you're always saving a bit of money, again, not financial advice, but if you're always, you have a sort of monthly amount that you can get into your portfolio, and that just allows for a bit of cushioning, so if you do think the market's a bit bubbly and a bit too overheated, you can just pull back a bit, and then you've still got the money coming into your portfolio, the cash, so that when it does crash, it gives you that opportunity when there's blood in the streets to buy more of your favorite stocks.
Have you been trimming a little bit at the moment?
Yeah, I have a larger cash position than I did. There's actually a video that I did on macro and economics back in my channel on October 2024, and I was talking about why I think the market was a bit expensive, and a lot of that still stands. So I have a much higher cash position than I did, and I'm balancing that with a few dividend stocks and some corporate bonds, not to return a great deal, but just to at least have a yield coming in that's higher than cash. And there are some stocks, some dividend stocks that actually have a negative correlation with the market. Whenever they crash, the dividend stocks, they at least tend to hold fire, but they sometimes go up. So I'm just balancing that a bit, just in case we get like a 20% haircut and I want to really double down into growth stocks that have crashed. Yeah.
Yeah, 100%. So if we move on to our first individual stock of the video, when the one that we both own, Hims Hairs, that is an absolute gem to be buying in 2022. What are your current thoughts on Hims and Hairs at the moment? Because I remember a few weeks ago you posted a video on Hims and Hairs, and your thoughts were similar to mine after the earnings, and it was a bit like it's still good, but with the run that it's been on and a few things that happened in the earnings that could have been a bit better. What's your current position on Hims and Hairs at the moment?
Okay, Hims is a very interesting company. Very interesting. I think I've done more videos about Hims than anything else. I just wanted to ask real quick, when did you first buy Hims? Because you were I think you were like the OG Hims YouTuber, right?
I've had it for a few years now, yeah. Um, I first came to me from a member of the private group, and when it came through a SPAC and it dropped down to single digit, and he said, have a look at this. It looks really interesting. It's dropped. All the hype's kind of come out of it now. And I remember looking at it and I was thinking, wow, this actually looks really good. It's growing really well. Profits ramping up on it. The healthcare space is massive, and they're going to do pretty significant amount of profit when they scale up. And I remember it dropping down from to $8.
But you doubled down when it was at 3, so that was before it crashed all the way down to like.
Well, I just continue to buy, $6, $5, $4, catching the falling knife, me. And I just remember like making videos on YouTube about it, and the earnings were incredible. That every time they kept bringing them out, and the market just kept sending it lower and lower. And I just didn't know why, because I was looking at the gross margins at 90% or 80%. Revenue kept growing at 40%. The profitability was starting to move up to a break-even point of view, and you could see the profitability ramp starting to come. And the market just kept ignoring it, and all the metrics kept going up. And one of the big negatives was that the revenue growth was only being supported by high sales and marketing spend. And I was thinking, well, it's just not true, because if you work out the sales and marketing percentage to revenue, it's coming a less and less of a percentage. So sooner or later, they're going to hit that inflection point where it's getting less and less, and that's just going to spot more revenue growth, and that's all going to go to the bottom line. But the market ignored it, and eventually it decided to realize. I mean, maybe it was a whole 2022 situation why the stock market just kept sending it lower, lower, and lower. But I think there was a lot of signs there that it was always going to work out for it.
What was interesting is like obviously, yeah, most SPACs they've now like failed, right? But you're right, like Hims was under that SPAC label. I think it got like bumped in with all of those other guys. And obviously, yeah, like 2022 market crashed and Hims crashed hard. It was kind of like, but if you actually look at it and value it as a SPAC at that original $10, which would have been what, a couple of billion in market cap, maybe like 2 billion of market cap at $10 a share, they actually didn't look that expensive relative to the growth. So then they crashed. I agree. $3, it was an absolute steal. And I bought my first shares in November 23 at about 8, and posted my first video about them, massive video in October 24. But to come to your question about what I actually think now, yeah, I explained in this video. I mean, first things first, like they're a 0 to 1 business. They are completely disrupting one of the most like archaic, slow to innovate industries in America, where people are used to innovation. Gen Z, millennials, used to doing things the 21st century way. Healthcare is not that. And couple that with the fact that the US has a relatively unique healthcare system, where it's just extremely complicated, and him simplifies all of that. Hence the 0 to 1 approach. So yeah, the last earnings I didn't like, and they were the first earnings that I didn't like since I invested in Hims and Hers. So I've seen about 6 earnings calls since then. And the main thing is that we agree on the point they're just going through a transition phase. The fact that you could work out, so from their non GLP-1 revenue, you could work out that that was flat at least quarter on quarter. It's not to say it's going to be flat year on year, but I think we'll probably see that non GLP-1 normalize to like 15-20% year on year growth. And as the GLP-1 situation starts to stabilize and we don't get insane GLP-1 growth anymore, Or we may do a bit because they're now working on in Canada, etc. But it's not going to be the same explosive growth that we saw. We may just see actual reported revenue growth slow down a bit in the short term to like maybe 20%, maybe even less. Who knows? Because this is the thing: is that most of the things that they're working on now, they've got all of these new verticals, but they've not quite deployed yet. We may not see that show up in the numbers yet. And my point is there were so many people since the start of the year that all hopped on the GLP-1 bandwagon. You know, let's not forget that towards the end of the year, yeah, Hims was trading between $20 and $30 a share, bouncing around there, and that felt high because a couple of years previous it had been at $3, $8. Um, and I just think all the people that hopped on this GLP-1 bandwagon and kind of just like have seen this almost, we had a quarter of triple digit growth, didn't we? And last quarter,
Yeah,
I
yeah.
think the year on year revenue growth was 70%. Then we're going to see a slowdown, even though we've got all of these beautiful things going on in the background, which I really, really like. You know, I love the fact that they're expanding internationally. I love the fact they're focusing more on preventative healthcare because that's a massive, massive industry that I think a lot of people champion. As humans, we all spend way too much of our lives sick. So I love what they're doing. And the most positive thing about that earnings call was Dudem reiterated the guidance, right? 6.5 billion in revenue for 2030. If Hims are still growing 20% plus, 8 times sales is quite a good multiple on that. And then you get 52 billion market cap, and they're at 11 billion at the moment. So that's nearly a 5x. I'm not saying they're going to 5x, but if they actually hit that and continue to
Yeah.
grow, 8 times sales is all right. 20% FCF margins at 8 times sales is 40 times free cash flow. But it's a big if. So now I think it's a bet on the management team, a bet that they can actually work on the new business areas. I just think that there's a few people who are going to be scared out the stock. I don't think we're going to go up to 100 in a straight line, but still a good long-term business. So it's still a holding of mine. I just can't make it a 20, 25%. It got up to 38% of my portfolio at one point. Had to trim that. So yeah, that's my thoughts on Hims and Hers. Yeah, how about you?
Yeah, it's funny that I remember saying where it was coming up more and more on my portfolio. It was getting to the point where portfolios moved where Hims and Hers were going on the day.
Yeah.
But yeah, I think my thoughts are very similar to where you're at the moment. Worth pointing out though, still that they're in this healthcare space. That's a massive TAM, and every time they launch some of these new products into these healthcare spaces, they're not just entering like £1 million TAMs. Are actually entering, some of these TAMs are worth billion of pounds, and if they do execute to the standard that they've been executing previously, they're going to have a lot of success with it. However, the problem that Hims and Hers currently have is that this is a company that has been accelerating massively up to these 100% growth rates. And it's just starting to see that slow down now with this GLP-1 business at the moment, and some other areas of the business are starting to slow down inside the business at the moment. And all these people have jumped in for this hype of this 100% growth rate, and then all of a sudden you start going down to 80, 60%, 40%. Is that we know the market's very short-term thinking, and all these people that have been rushing in will then panic and move out the stock. And even though if this company grows at 20-30% rates in the longer term, it's still going to be okay for Hims and Hers. The problem is that in the short term, we see the market panic, and when it starts dropping at those sort of growth rates, what we'll see all of a sudden is we'll see a company that used to be trading at the 60 times earnings will drop down to a 40 times earnings because it's just not growing as much. And it doesn't sound much, but a drop to 60 times earnings to 40 times earnings is about a 30% drop, which I think right now, I think Hims and Hers is actually on a 30% drop at the moment.
34, is it 34% below all-time highs? You mean?
Something like that, yeah.
Yeah, I think
It was
that's about
30% the other
right.
day when I looked at things.
Right, okay. Yeah. I mean, look, the thing is that there are two things. It's going to make it exceptionally volatile, right? You and me are definitely going to be on a journey. We're both still invested in Hims and Hers, and Hims is going to be a journey, and it's going to be a fun journey. But obviously, number one, you've got massive interest in the retail community. And Dudem's acknowledging that, which is great. I'm sure you know, like the Hims House podcast, but they get questions on the Hims earnings call, which I really respect. They had Dudem on the podcast themselves, so massive respect to them for being able to do that. But you've got a massive surge in retail interest in Hims, which
Mm.
I didn't see so much when I was investing in late 2023. So that makes it volatile. And then you've also got the short interest. So you've got over 30% of the float being borrowed. So you've got a lot of leverage on the HIM share price. So either way, it could be very volatile. And I think if we get a negative or just a bad couple of quarters where they're saying, "Oh yeah, we've got all these growth opportunities. Look at our growth opportunities, but our core growth has been flat again, or our overall growth is now down to 15, 20." The stock could shoot back down. I don't think in the short run it could get sort of lower than 2025. I think that's a good support where because there was a lot of pre GLP-1 investors investing it at that point. Of course, if it goes very positive, then you could get a lot of momentum coming out of a short squeeze.
Mm.
And there's still like a lot of uncertainty about how they're going to piece together the rest of their business. But all I can tell about Hames is that it's a ride. It's going to be
Yeah.
a ride. So much has changed in the last 2 years. Mad respect to the management team for doing a great job. And they did get from founding in November 2017 to crossing over 1 billion in annualized revenues in 2024. So that's 6.5 years. And that's on par with what Amazon and Alphabet were able to do. Not many companies can go from
Yeah.
literally what an idea in someone's head to 1 billion in revenue in 6 or 7 years. So either way, even if they don't become the multi-$100 billion company that they could be, massive respect to what they've done so far. And Dudam's still a very young guy.
With just on the last point here with Hims and Hers, just on your positioning on in the portfolio, it was your largest position in the portfolio. Where are you at now with your position on Hims and Hers? Has it come to still a top five holding? Is it a mid position? Is it a smaller position? Where are you at with Hims and Hers at the moment?
It's actually one of my smallest holdings.
Well,
Yeah, so it was at about $60 a share. I reduced it quite a lot up to that point. And at about $60 a share, I cut it to about 4.5% of the portfolio. And obviously now it's lower than that. Like the share price is lower than that. So the weighting's probably gone down to about 3.6, 3.7.
mm,
Yeah, so it's still there. Um, but yeah, I think that we're just not it's just not got the same risk reward that it did. That's
yeah.
that's it. Like I'm very happy with where it's gone, and you still look at it in less than a 2 year period. I've 6x my money, even though we're way off all time highs. I mean, and you've done even more than that, right? Because you've been dollar cost averaging down. But yeah, I just didn't think that it represented the same insane opportunity it did in like 2023, early 2024. What's your weighting?
Yeah, for me, Hims and Hers is actually still my number one holding. The only difference is that it used to be far away my biggest holding, and now it's just slightly above my second holding, which is Google at the moment, which makes me feel a bit better. Maybe it should actually be a little bit smaller than where it still is. I guess the big difference in the position at the moment is that obviously, like saying, a lot of my average was around the $6 mark. So the gains that I have really are not actual my invested amount gains, if you know what I mean. If it was actually money that I invested, it might be a bit of a different story. But the money that I have invested into Hims and Hers is actually a normal size positioning, if you know what I mean. So it's a lot of it is paper gains. So if it was actually money invested, I might be a lot keener to trim the position down. But because a lot of it isn't really my money that's invested, I think I'm a little bit happier with that waiting to sit a little bit larger. So yeah, that's where I'm currently at with Hims and Hers at the moment with my positioning.
Interesting.
Yeah. So I guess that takes us on to some other healthcare stocks. Some other ones are having a big tough time at the moment, like Novo and Oscar Health. Just wondering your thoughts on any other healthcare stocks, any other ones kind of catching your eye at the moment?
Yeah, there are a couple on my watch list I don't know a huge amount about. I will touch on Tempus, or like they're on my watch list. I've yet to do the deep dive on them, but I'm kind of interested. And I'm
Right,
interested to ask about United Health because I know you touched on that.
right.
Because that looks very cheap, and that's another story. But Tempus, I have a holding in. I've had a holding in Tempus since the start of the year. Very, very volatile. So I trade Tempus quite a lot. And also, it's very expensive and kind of unclear at the moment because they've just done an acquisition. Their weakness and I'm sorry if you're listening, anyone from Tempest, which you're probably not, but their weakness is capital prudency, and the CEO Eric Lefkowski previously ran Groupon that grew very quickly, but maybe just overextended itself and has since kind of just faded away into not very much. They're still a public company operating, but they've just kind of faded away. Anyway, Tempest is very interesting because two things that make it very unique. They're AI from the ground up, and they've been focusing on AI since 2015. So they're an actual AI. They've not been using it as a buzzword since 2023. They're an actual AI first healthcare company, and they've got extremely unique data advantages because they've got data. They've got the largest like cancer data database ever. It's like 20 times the genome atlas. I can't remember what it's called. They've got a massive data base, and obviously that data, healthcare data, is very sensitive. It's very difficult to obtain, and I can go into it more if you want. But there's they analyze people's genomes and profile and tumors to basically recommend different treatments for doctors. So they collect that data in that way, and they can aggregate insights, and then they have a data and services business, and they can sell those aggregated insights and help big pharma companies and things like that. The fact that that data is difficult to obtain makes it unique. That stops like one of the big guys that may have superior AI from creating a more powerful AI. And AI is only as good as the data it's trained on. It's very different from like, oh, you and me build a weather app, an AI that predicts the weather. Oh yeah, Google can just run us over because Google's got better AI and everyone knows what the weather's doing. That's easy data. Contrast that with healthcare data is obviously there's a lot of like protection laws against it, etc., and only certain people have access to it. But Tempest is an interesting one, definitely high risk. They've got a long way to go until they're like optimized, but they've got a big acquisition. I really think they have a lot of potential. Very expensive. The best I can value it is probably on gross profit. They're 35 times gross. And it's important to look at gross because they've got two different businesses with different margins. So value it on gross profit if you look at Tempest.
I was just looking then when I never heard of it before. I was just looking when you were talking, and it's growing like a weed at the moment. It's growing at like 89% a quarter in the latest quarter. The only thing that would put me off
And some
this
of that's
is,
from the acquisition, but I think organic is still going to
oh
be
yeah,
about 35-40. Organic still 35-40. And once they've actually synergized the acquisition again, then we'll see what the organic growth is. But yeah, organic still like 35-40 on the top line.
yeah, yeah. The other thing that would put me off this is that I've got a rule that I invest in. It's got to get to a break even point of view in 2 years of investing. And I'm just looking now and I'm not sure if it's going to do that at the moment. And that would maybe put me off at
Do you mean on price action or on net profit or on free
net
cash
profit.
flow? Net profit. I would probably agree. That will be much more clear once they've actually simplified everything with regards to the acquisition. But I would agree. It's like they've got the potential of HIMS, although it's different. They're more like AI and data focused and less sort of consumer focused. But HIMS had a much better time in terms of their financial prudency, and I always like that about HIMS. Yeah, with Tempest, you don't know exactly when you're going to break even, and that's why I mentioned that it was the weakness. Is that the CEO ran Groupon, and Groupon had massive losses for a long time. So, and also this is the thing: it's like he's already rich. Not that that's his motivation. His motivation is that his wife got diagnosed with breast cancer, and he was just really frustrated that about personalized medicine. That like what, like someone's sick and you're just going to do spray and pray. Oh, this chemo works. This chemo works. He wants to completely change that, starting in oncology, but they're doing a lot of other segments of healthcare as well. So the thing is that is his number one goal financial prudency right now? Probably not. Yeah, they're growing and they're taking advantage of growth opportunities, and they've got a lot to do. They're a very ambitious company, but yeah, that's the main risk, is that can they actually get profitable, and are they more organically getting profitable, or is the acquisition that I think is profitable, is that just going to make it look more profitable? Do you know what I mean? Then they're going to then they're going to get back into the same habit of maybe growing too fast. So Tempest is a high risk one. But yeah, those are my main healthcare stocks for now. I looked at LifeMD. I'm not too keen on LifeMD.
Yeah.
What about the United Health situation? Because they've crashed a lot, And that's not a business that is easy to destroy.
Yeah. I decided to stay away from United Health. So it's been something I've been thinking about for a while, and eventually went, you know what, I'm gonna walk away from here. Um, I don't normally like invest in healthcare space, which is funny because we just mentioned about Hims and Hers, but the difference is with Hims and Hers, it's control their own destiny. You know, it's all funded from the clients. Whereas with the United Health, you've got all the Medicare health issue going at the moment. The big thing that puts me off or put me off with United Health is when the DOJ investigation came out about the fraudulent claims. That just really put me off. That's a red flag that made it unvestable for me. And the fact that it was obvious as well that there was some sort of investigation that they're going on, and they lied about it. And originally they came out and said, no, there's no investigation going on, and they denied it. And then we saw from the eventually, like a month later, they said that actually, oh, there is an investigation going on with DOJ, and that was just, for me, that was like complete red flag where I can't touch it. For me, I don't know if it'll end up being anything major, but for me, I like to think worst case scenario, and I think that was enough to really put me off at the time. The only thing that puts me off is, like, it's been an absolute gem of a performer, but for me, I just get so nervous because I just find it really hard to forecast that healthcare space, and the cost from the healthcare plans, and this is there going to be a surge of treatments, and it's just too hard and too foggy to forecast on the guidance.
I get that. I get that. And it
Is
kind
it
of
one
goes
you're
back to what we
interested
were
in?
saying earlier. It's like United Healthcare. This is the problem. And there's actually, I don't know how much you know about Lemonade, but they're in the insurance space and they try and solve this problem. But I don't know if they do it for health insurance, public company, and actually doing really well. But the issue is that there's literally like the health insurer is against the consumer. So okay, like whatever, United Health, come after me if you want, but make they make a business. I mean, you look at how much premiums have gone up, right? This is why that there's such an opportunity for Hims and Hers. Premiums have gone up, deductibles have gone up, like all of so much of the cost of healthcare is just because of the actual like deductibles and the cost of health insurance. And United Health, unfortunately, I think that they're going to do well. I don't necessarily want them to do well just because they have such a breadth of control over the healthcare industry. I mean, what was their market cap before they crashed? Like 400 billion,
Oh, it's
500
massive,
billion,
yeah.
something ridiculous. It actually shows you how big the healthcare industry is. And that's what's nice about like looking at Hims and Hers and LifeMD and these kind of companies. I'm not saying that they're like absolutely perfect, right? But it's like a damn sight better than this kind of healthcare company where you have to pay for this health insurance and they actually make more money by denying your claim. So yeah, I think United. I honestly don't know like the ins and outs of the recent situation with fraud, but it also depends on if you're comfortable in investing in a company where instead of being that 0 to 1 business that's actually making a positive like step towards the future, you're kind of just rent seeking. You have so much control. Um, it's just yeah, it's just crazy. But whether it's a good investment or not depends because I do see it's very cheap. I do think the revenue will grow, and unfortunately, in my opinion, I do think they will be around for a very long time.
Yeah, yeah. I think you take the point of view that if you come back in 2030 and United Health going to be higher than where it is right now, I do think it's going to be higher than where it is right now. But the thing is, I don't need to own every stock that's out there. I just need to own the ones that are the best opportunities that I think, and the one that I've got the highest conviction in, the 100% conviction in, and the ones that I'm comfortable with. I don't need to have the controversy with it or that's going around with United Health, and I just need to own what I'm comfortable with. And there's going to be some stocks that I look at and I think won't work out, and don't invest them, and they'll go up and I wish I bought them. But at the end of the day, I'd rather just be able to go to bed at night and sleep and know the stocks that I've got with my money in are the high conviction ones, and that's the better place to be in.
Absolutely. Look, I love the fact that I think there's about 25,000 public companies in the world, about 6,000 in the US, a couple of thousand in the UK, but about 25,000 in the world. And this is the point. Like you touched on the bottom point. You only need a few. It depends on your risk appetite. Some people do five, some people do 10, 15, 20. By the time you get to 25, the cost to your time and energy of adding another stock is quite a lot. Like by the time you get to 30 holdings, it's a lot. You don't need more than 30. That allows you for over 99% of the market, or 99.9 if we're counting the 25,000, to say no, 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 no. So it's easy. Yeah, like United Health might go higher, but if you're unsure on the thesis or if you have ethical concerns about investing in it, that's fine. Move on. Like nothing bad happens if you don't invest in a stock that does well. You just want to avoid investing in a stock that doesn't do well, right?
Yeah, 100% exactly. So moving on to the Mag 7, what are your current thoughts on the Mag 7? Is there some that you like, some that you don't like? What's your current thoughts on the Mag
Mag
7?
7. All right, Jacob, let's play a little game. There's two Mag 7 stocks that I don't like. Have a guess which two I don't like.
Ooh, well, I know it's not going to be Google.
Yeah, I like Google.
Yeah. Big fan
It's
of
funny,
Atkins.
actually. Google just came on my largest holding. It's funny how we had the same thing. Hims was our largest holding. Now, like Google's on both our largest holding.
Amazon, I think you're a fan of.
Mm-hmm.
I don't believe I've ever heard you mention Meta before, but I think you've got to be a fan of Meta.
I don't hate Meta.
Yeah.
I was a big Meta investor when when Wall Street thought the whole company was dying about 3 years ago. I'm not a current shareholder, but they've done very well. Yeah.
I'll go Tesla as one that you don't like.
I don't like Tesla.
Yeah.
Not necessarily as a business, but as a stock. I don't like it.
Yeah. The other one being, we'll go with, see, I think you like Microsoft.
I do like Microsoft, yeah. Yeah, I'm trimming it. It is a holding of mine, but I'm trimming it now. But I do like it, yeah.
So I'll go do one video then.
I like Nvidia.
All right.
Trimming it. I don't like Apple.
Oh, Apple, yeah.
Yeah, I mean, so that's my thoughts on the Mag 7. Like, full disclosure, Alphabet I've been accumulating, and I really like. I mean, I like a lot of things about Alphabet, but like I watched their whole like suite of AI products come out, and I was like, wow, this is good. Obviously, you've seen like VO3 pop up everywhere, and you understand their capabilities. They obviously acquired DeepMind, which is actually a British company, and Alphabet have done so much behind the scenes AI stuff. We're starting to see that come into the enterprise. They're at a cheaper valuation than most of the other Mag 7. And also they're more vertically integrated. Not a lot of people make this point, but like OpenAI is not Microsoft. Yeah, I know Microsoft has an interest and has equity, but they're not the same thing. The same way that like Amazon is not Anthropic. Like, yeah, there's investment, but Anthropic, which is Claude's large language model, which is doing well, is a different thing. Google, a Gemini is actually designed from the ground up by Google. So I love Google. They've got great distribution for AI. Microsoft is like the steadiest Eddie ever. Microsoft was a large holding of mine up until recently because they didn't have a good 2024. And I was like, look, like Microsoft's not really getting the credit that it's due. It's just an absolute powerhouse. So I had a large holding of Microsoft that I'm trimming. Amazon and Meta were always kind of on the watch list. I've invested in those in the past. I'm not invested in them now, but as I said, like I do kind of like them. Nvidia, I've been a shareholder since February 2025 when they took a bit of a dip, and now I'm thinking about trimming that again, but still a great holding. Apple, I mean, again, I'm talking about a lot of stocks, so just I'll finish, and then if there's anything you want me to expand on, I will. Apple, I think the valuation is just too high, given they're lagging behind in the AI race a little bit. I mean, iPhone, again, sue me, Apple, whatever, but like iPhone 14, iPhone 15, they've made great iterations, but they're just not quite the bee's knees for the valuation they've got. And a lot of their growth has just come from lots of profit, buying back their shares, higher earnings per share. But I mean, what did I say earlier? I like the top line. Apple's top line has been bad in the past few years. And Tesla, I just think it's risky at the market cap that it's on. Like you've really got to believe in their approach to autonomous driving and energy storage and robotics. All of those are fantastic industries. It's just like for their market cap to already be at $1 trillion, what if it triples this most valuable company in the world? I'd be much more interested in Tesla if the shares were about half the price that they were, or even less.
Yeah. The thing with Tesla is that I like to see the proof that they can do what they're saying they're going to do. But there's just not the proof at the moment. That's the big issue, isn't it?
You hit the nail on the head. I mean, you it'd be a funny game. You could play Elon Musk and you could be talking about, oh, next year we'll have 10 million robo taxis on the road. And you could play a game of like taking that clip as like, which year is it? 2016, 2019, 2022. I mean, they are making progress, but that's my point. Core automotive revenue is kind of stagnant or even declining a bit. Energy storage is doing well. But it after a while, it's just like, do you really trust their timelines? And when I don't
Mm.
trust their timelines on something where I've not got the quantitative proof in front of me yet, it's very hard for me to value it properly.
Yeah, and that's the problem. The timelines are just all over the place. I mean, they were mentioning the semi truck a few years ago, and then it disappeared from the press releases. I think they finally mentioned it again in the last earnings. A few years ago, they were coming out and saying they were going to grow 50% a year. I mean, what happened to that? That was only 2 years ago, and then got anywhere close to that in the last few years. And I don't even know what they're growing at now. I think they're back at something like negative growth right now, which isn't great.
Yeah, I think the
Just
forecast is
not.
-5 for the full year.
Yeah, and the problem is they're just massively going in the wrong direction right now. Like, don't get me wrong, if some of the products do hit, like they could be absolutely massive, but the problem is, are they going to hit? And for me, it's just the same as going down to the casino and betting on red or black. I'd feel a lot better if you could see the needle starting to move into the right direction, and you're like, okay, they've got something starting to happen here with the business. But right now, you just don't really have that with the stock. The thing with Tesla is that when you look at the valuation, a lot of this is already starting to get priced into the valuation that, some of these things are starting to hit. And that's another big issue that you have right now with Tesla.
Yeah, tell me about it. I mean, that's the thing. We've got stagnant revenue growth for the past few years, and you're just making a bet on something that may not work out. And again, looking at it on a gross basis, which I like to do because obviously Tesla has much lower margins being an automotive company compared to something like SaaS or infrastructure, which is growing much more. I've just got the figures up. Tesla's at 62 times gross with a 5% decline forecasted in revenue next year. Google's obviously at 14 times gross with 13% growth forecasted for this year. So it's just that the risk reward with Tesla is not worth it. If it was like a couple of 100 billion of market cap, that would be really good to just sort of take a bit of money and just put it aside and do a coffee can approach. Leave it in a portfolio for 10 years. Maybe it works out with Tesla. A 1.1 trillion market cap, I agree. It's just not worth the risk reward.
Yeah, and a lot of people think I actually hate Tesla, but I don't. It's made me good money previously. It's just that I just don't think they're doing well at the moment. With the other ones, I think that Apple, my thoughts are similar to yours. I think that they've lacked innovation since Steve Jobs. I don't think they've brought out any decent products recently. Even the glasses that Apple did were behind Meta's by a far amount. I think that a lot of it is being propped up by the share buybacks, and to do the share buybacks, they took a lot of debt on, so the balance sheet isn't as good. The growth to the valuation just isn't that good, really, at the moment. Amazon, I currently own at the moment, with also Meta. I own Meta as well, up about 300% on Meta at the moment. And yeah, big fan of that one. Been owning that one since 2018, but also added in when they had the kind of big TikTok killer days when they were talking about that. Microsoft I've owned since 2017. Up a good amount on that one. I hardly ever say that I would hold the stock forever, but with Microsoft, that probably would be the case with that one. That I'd be willing to hold that one forever. Um, and then Google, yeah, Google is my largest holding out of all of them at the moment. I think when you compare it to the other ones, you got the just as good valuation. The growth is just as good with that one. You obviously got the cloud that is ramping up on there. You kind of get that free bet with Waymo at the moment, with Google at the moment. Great balance sheet. You got the share buybacks going on at the moment, and obviously, as of the week just gone, obviously we got the big news that Chrome they're going to be able to keep Chrome.
There we go.
Yeah,
8% is
YouTube.
quite a lot for Google to rise. A very steady company like Google, 8% is a big rise we
Yeah.
saw a couple of days ago. Yeah.
And I think YouTube as well, that's just going to get more and more market share, mainstream the younger generation. That's the go to platform to view content more than Disney Plus, more than your likes of Netflix.
Yeah, true. And another thing about, we're obviously just like not particularly bullish on Apple is like, okay, so Alphabet are ahead in AI. My girlfriend's got a relatively new Google Pixel phone, and they're just able to integrate that AI very well. So, Google they do have an ecosystem there because they've got a lot of hardware product as well.
I think what happened with Google and Gemini is they just got off to such a bad start. I think when they did that presentation and it started showing the wrong things and started doing the wrong things, it just kind of knocked it back a little bit. But I think now, you look at the product they have, I think it's probably the best that's out there. It's personally the one that I use at the moment. I tried using the other day as something for a project, and I used Gemini and Gronk, and Gronk struggled, and Gemini was by far the best.
Interesting. I think what may have happened is obviously ChatGPT came out 30th of November 2022. Then, by a few months later, it had hundreds of millions of users. Google then started to panic because obviously search still makes up the bulk of their revenue. And I think what happened is then they released their large language model, which was called Bard at the time. And because I think Google, because they had deep minds, they were working on all this AI behind the scenes. And I think they panicked a bit, to get it commercialized when it wasn't actually ready because they're like, shit, if we don't throw it out there, even if it's not going to be as good as ChatGPT 3 when it was back then is at least if we throw it out there, then we will gain some traction, which I think was a mistake because they damaged their brand a little bit. But now they're really starting to show the behind the scenes of what they were working on. You think it's one thing a chatbot, or not chatbot, sorry, a large language model, not chatbots. They're really sophisticated tools, but it's another thing. I mean, you see some of the VO3 stuff, the video that comes out, just the prompts that you enter in and what comes out the other end. That's so much compared to the large language model. It just that signifies to me how much AI Google really have behind the scenes. Look at the progress they made. ChatGPT has changed and improved, but look at how much Google's AI commercial products have changed in the past 2 years. That leads me to think they've got even more impressive stuff behind the scenes.
And the thing you were going to say there as well, the valuation side of it, I think that Google is the best AI platform out there, if not one of the best AI platforms out there. And yet the valuation disconnect to all the other platforms that are out here is so big compared to them. And you look at what you get in Google with all these products and this AI product here, it just doesn't make sense why Google is such a disconnected valuation to what the rest of them really.
Yeah. Yeah. I think that's because there's a magnified volatility in there because of the fact that if it didn't work out for Google, search would be disrupted. But what's nice is now that they're really showing that they do have very, very powerful AI that they're working on. And this is the other thing is that they've got the distribution of search. So I know a lot of people, particularly like a lot of the younger generations, are now used to going on another large language model. Obviously, ChatGPT is probably still number one. However, that's not everybody. And a lot of people still go on and do a Google search. And now you're like automatically getting some of the Gemini features on Google.
Yeah.
So that distribution may start to help them. And there's that point we raised earlier about, okay, yeah, ChatGPT isn't Microsoft. It's OpenAI and Microsoft are backing them, but Google have that vertical integration and they've done it from the ground up. And also Waymo they've done from the ground up. So that, I mean, takes very powerful AI to run an autonomous car. So it's very clear that Google definitely have something.
So I guess that's a good time to transition onto our next topics, which is AI stocks and AMD on that list. Maybe it's a good time to start with AMD and your current thoughts on AMD at the moment.
Do
You
you
go
want to
first.
talk about AMD? Yeah, I'll just say like very quick. I invested in AMD as as almost like a value play in the fact that I thought Lisa Su was a fantastic CEO. There's arguments to be made that they're going to be very good on inference AI, which is going to be very important as we shift towards agentic AI. So actually, just like live use cases for AI, not just kind of something that's pre-trained, but something that's like working with working with the data in real time, and then giving you, updated advice or decisions or productivity based off that data live. There's arguments to be made that AMD are going to be very good at that, and that they were just, as we said before, they were just neglected. Like, it was just a contrarian play, neglected by the market. It was easy to be an Nvidia shareholder, and now anyone that actually doubled down on that at like $100 a share or less, or even 120, because they're like 170 right now, did very well. But I know that you talk about AMD a lot on your channel, so give me your take on AMD.
Yeah, just bit what you were saying there about founders. Yeah, I mean Lisa Sue, I mean she wasn't a founder, but she was nearly as good as a founder.
She turned the company around. I mean, AMD was dead in 2013, 2014, and she has
Yeah,
completely transformed that company. It's been
yeah.
like a 25x probably since then.
Yeah, 100%. And she's nearly a founder. But when we were looking at AMD, really, it's a bit like what we were talking about before we started recording this video, which is that it was the market just being slow to realize that they were starting to just turn the corner a little bit. People wrote AMD off and it weren't going to benefit from the AI situation, and they were slow to adapt to it and get great products out. But now, they're starting to catch up, and the market was just ignoring it, and the key signs were there that they were starting to get better products. They're starting to see that revenue growth starting to come in here, and like we're saying, the market just completely ignored it. And you start looking at now if they're going to become a major player in this space. The amount of TAM that they're going to be able to take from this space at the moment is going to be massive for them. And we're starting to see the key signs of them turning it around right now. But the thing is with AMD is that the key products as well is that when it starts coming in the MI 400 next year, that's when we actually start seeing the real big turning points. And yet the market just were valuing it down to what, $60 a few months ago, and now suddenly it's starting to realize like, oh, actually there's a serious products coming in here. So I think we're already starting to see the turnaround signs here, and I think that this is the starting sign. I think in a few months' time, when some of these new products come in, it's going to come even more clear. Like Nvidia's finally got a little bit of competition here.
Hmm. Yeah, I think so too. And they're only at 260 billion market cap. You compare that to Nvidia. Nvidia's at 4.2 trillion. So there's a
Mm.
huge gap to be there. And this is the thing, is like the hyperscalers that we just talked about, they all need this hardware. They all need this hardware. It's like, okay, so businesses are going to utilize AI. So they use some software, some AI, and all of that falls back down to the hyperscalers that have the infrastructure, the cloud providers. And that falls back to AMD and Nvidia. So the base bricks of this pyramid. And in fact, one step below that is TSMC, which is another one of my largest holdings. Like
Yeah.
I bought Nvidia and AMD, but I held TSMC for a very long time, since like $80 a share back in mid 2023, because I was trying to work out this Nvidia AMD argument, and I know that I own them both now. But I said, look, if I'm unsure, like there's people that know a lot more about semiconductors and chips that they're unclear about who's going to win this race, right? It's not a decided race at all. But of course, Nvidia is getting a bit more credit at the moment. I just said, look, like these these two companies are fabulous. They don't have the infrastructure to actually physically produce. Yeah, they design, they distribute, they own the IP, but they are not the manufacturers. So I said, let's invest in TSMC, and I did really well out of that. A lot of people say, oh wow, like China could invade Taiwan or whatever, and that's actually a real geopolitical threat, seriously, particularly when you've got the US and China being the two main AI players, the two main military powers, etc., in the world. If we're going to have a change in global world order, it's going to be China that comes up. And Taiwan, 80-90% of the foundries are in Taiwan. Luckily, TSMC are geographically diversifying a bit away from Taiwan. That will take time. And it's like they're all on the west coast of Taiwan, 100 miles from China. It's a crazy situation. But my whole thinking is, yeah, China can't also damage these foundries because they need the chips. They're not going to nuke Taiwan. And if they do, then it's like what's the point? It's not just going to be TSMC that suffers. Then
By
Nvidia
then
is
you're
going to
gonna have bigger
suffer.
problems.
Then Microsoft, Google, Amazon are going to suffer. Then everyone's going to suffer. And like we might as well then invest in Coca-Cola. So
Yeah.
yeah, that's the big risk with Taiwan Semiconductor. But I mean, if that happens, you've got to start worrying about, oh shit, is like all innovation going to slow down? should I start growing carrots in my garden type thing.
Yeah, yeah. Is there any other stocks you want to talk about, or shall we go on to the next one?
Um, there's one in my top three, but I know we've been going for an hour 10, so I'll talk about it at the end when we sort of talk about stocks we're looking at the moment.
Yeah,
Let's talk
cool.
about Monday. I'd love to talk about Monday.
Yeah, yeah, cool. So we were talking before we did this video, and Monday.com is one that's quite high up on your watch list.
Yeah, actually very high up in my watch list. Yeah, I
Yeah.
need to set aside some time to actually just watch a few more earnings calls and dig into the founders a little bit, but I'm very interested. And I'll tell you why. So I'll start with, there's a guy called Pat Dorsey. You may have heard of him. He now runs Pat Dorsey Asset Management. And when I first got into investing, I read a couple of his books, and they're both really good books. There's a little book that builds wealth, and the 5 rules for successful stock investing. And Pat Dorsey's speciality is economic moats. So these are quite qualitative books that talk about a company's durable competitive advantage ingrained in its business economics, right? And a couple of years ago on the 13F filings, because his management company's large, so he has to release his 13F 45 days after the end of the quarter. And he had Smartsheet as a holding for a very long time. Now, Smartsheet has since been acquired by someone else, um, not by another public company. I think they went private. But Monday does a similar thing to Smartsheet. So the economics are very similar. Smartsheet was this guy's largest holding back in 2023, when usually the likes of Meta and Microsoft and something a bit safer are its largest holding. Smartsheet also had a similar market cap to Monday, about 5 to 10 billion in range. But my point is, he's the expert on economic moats. Monday has very similar economics to Smartsheet. They do very, very similar things, although Monday is actually much more customizable, much more of a dynamic workplace tool. Smartsheet was a bit more of like a kind of Excel classical style, much more what like Microsoft could have done with Excel. So that leads me to the point that like the business economics of Monday are quite favorable, in the sense that you've got the classic SaaS switching costs, but
Mhm.
you've also got that switching cost because instead of just like a few people using some software, there's all of these different users. So and the fact it's highly customizable. Think about, okay, if you're going to switch to another project management tool, you've got all
Mm.
of these users on something that's incredibly highly customized. Think about the switching cost of that, right? And then the other one, like what Dorsey deems the most powerful type of economic moat, the network effect. The more people on Monday.com, the more people it benefits. So what Monday do, for anyone who hasn't heard of them before, as I said, they're a collaboration tool, like a software collaboration tool, just designed to help workflows get tasks done. As I said,
Mm.
it's heavily customizable. They've got all kinds of things going on at the moment. Big push into AI, but yeah, like that kind of tool is, as I said, very sticky in terms of switching
Mm.
costs. And the larger it gets, the more ingrained it gets into an organization, the harder it is to get rid of it. The same with like, oh, we're all using Microsoft OneDrive, for example, or Google Drive or whatever. It's very difficult to then migrate everything else. But the fact that it's customizable adds a whole nother layer to it. I have a friend of a friend that works for Monday.com, so I got my friend to
Wow.
speak to the friend to get a bit of intel. And basically, okay, so let's talk about why they crashed. They
That was going to
crashed
be
for
my question for you.
okay, because that's important, right? Because that's why we're interested in it, right? Like they obviously
Yeah.
crashed for a reason, or did they? I mean, not really. Their raw growth in customers was not as fast. However, they're massively focusing on enterprise, which is good. So they're focusing on expand more than land. They're focusing on really big enterprise customers, because the difference between Smartsheet and Monday is Monday also, they do have a market for the tiny businesses, like 3 people in the office that make a tick list. They do have
Right.
that market as well, a little bit, but that's really not where the value's at. Like anyone, any person in their bedroom that's adept at code and app design can make a little tick list thing. What Monday are really going after is highly customizable AI enterprise solutions for project management. So they're going up market. I think the stock market got a bit scared because the slower overall customer growth but that's number of customers. It's not number of users. Number of users are just growing because obviously like one customer, i.e. one business, has a growing number of users because they're going after enterprise. And of course, like the long-term theme is like work from home. Less people are in the office talking and nattering about. You've got a big company with a lot of different branches. Everyone's in a different place. So something like Hims, right? They don't. I don't think they. But they're very very big on work from home culture. They do have an HQ in San Francisco, but it's not like all the Hims and Hers employees all go to the HQ all the time. They're big from work from home. And I imagine when you've got all that stuff going on, you need something like Monday.com to organize everything. As I said, the risk is, oh yeah, AI eats SaaS. But from what I understand, they're very, very much AI driven first. Monday.com reported more than 150% quarter over quarter, which is crazy. Growth in AI adoption, 27 million AI driven actions by Q1. I'm not saying they're an AI company, but they're hedging against being destroyed by AI. And they're much less likely to be destroyed by AI because of this network effect and switching cost. If you had a software that just did some random thing, that's different from having such a broad base of network effect where all the users need to interact with each other. Makes migrating very difficult. A couple of other points. 26.3% forward revenue growth at the midpoint. So they didn't raise their guidance. They didn't cut their guidance. They just narrowed the range. So I'm not too bad with that. 26.3% growth. I mean, they grew 33% last year. So the rate of which the revenue is growing is not slowing down that much, given they're growing quite fast. And they're quite big. 1.2 billion of revenue. 1.2265 is the midpoint of the guidance. Yeah. And now they're trading at 30 times forward cash flow. As I said, with 26.3% forward revenue guidance, which they'll probably beat by a little bit. And they still got the two co-founders there at the helm. So that's what you were saying earlier about really, really focusing on a business where you've got a good captain there that's really going to take care of it. They've not got one, they got two, both working together. And it's been at a 15 billion market cap before. It's currently about 9, but it's been at 15 before. The reason that I mentioned that is it's already on the NASDAQ. So if they recover, do well for a couple of years, we may start to look at NASDAQ 100 inclusion. And also the share price seems to have these big scares and then recovers quite well. It actually seems to like follow the NASDAQ quite well. It's beaten the NASDAQ since the low points, but it seems to crash and then kind of recover. You know, some stocks, how you're saying they just go nowhere. Monday seems to crash a bit and then the market realizes not that bad and then they recover. Risks, I mean, Microsoft and Google, they have the distribution and they could build this kind of thing as well. So that's a genuine risk because they got way more distribution than Monday.com. But I mean, it's kind of the risk with any tech companies. Like, yeah, Microsoft or Google could do something.
Would you not think at 9.5 million market cap, there would be more tempted to acquire something like this rather than having to build it themselves? It might be a better.
Yeah, I think that would be, I think that would be very plausible, particularly because, like Microsoft and Google, they can do anything, but they can't do everything, right? And look at also how much money they have. Okay, like, right now was a year of heavy capex spend, but you're right. Maybe they'll just say buy. And I mean, Monday, it goes through its periods of being cheap. But I guess Microsoft and Google, if there's a big TAM with this, which there are, like the TAM is people work. Like that's the TAM. So the TAM's really big. Like people work in projects and organize themselves in a service-based economy in the 21st century. So really, really good. I'm invested in something similar called GitLab, which they do this, but for DevOps. So that's more about code and creating software.
Did they have earnings yesterday? Did they drop a little bit off earnings?
Yeah, they dropped a little bit. I looked at the earnings. The earnings were very average. There wasn't anything in there that was a big red flag. Wasn't a fantastic earnings report. It was very average. And this is the thing, is that if GitLab was priced for perfection, I think they would have crashed more. But this is why it's nice. It's like you own a very volatile tech stock at a good price, and when they have earnings that are not great, maybe 4 out of 10, they don't crash so much. So yeah, I've spoken a lot. The last thing is, I mean, we don't need to go into this at all, but they are based in Tel Aviv. They've got offices all around the world, but they are, I think, headquartered or based in Tel Aviv. They've done a lot to diversify away from Israel as well. Just thinking about, obviously, Tel Aviv is not very far from a war zone right now.
Mhm.
And the employee that my friend spoke to said the war is causing minimal disruption to their business. Obviously, the war's not in that part, like it's not in Tel Aviv, but it's obviously close by. And they're not, they haven't got like a manufacturing facility or something like that in Tel Aviv. They're all a online based company, so they're a bit more agile should things get worse in the Middle East. But I know I've spoken a lot, so let me know if you've got any questions or any thoughts.
No, I've not really got that many questions about it, but it certainly looks interesting. I've never had enough time to really look into it, but since you mentioned about it before coming onto the show, I thought I'd have a bit of a look at it last night, and what I saw, it actually looked pretty decent. To be fair, the revenue growth is still pretty decent. You're looking at how much it's been sold off, back to 2024 levels at the moment. They're not making any income or that much income from a net income point of view, but they are doing pretty decent levels of free cash flow at the moment. I think if you look at 2026 price to free cash flow, it's around about 20 times earnings, 20 times free cash flow at the moment, which is pretty significantly below what they've historically traded at, which is like a 40 times free cash flow level.
If you just look,
Um,
so here's another way to do it. If you were to like cover up the name of the company and didn't know anything about the business and just looked at this on a numbers point of view, also taking the valuation into account as well, you'd say, wow, that's very good. 26% forward revenue growth. The free cash flow margins were 20%. They're now down to 26% forecast. That may be something to do with the fact they're investing heavily in AI. Gross margins are very high. But I mean, just that, like
yeah,
26% growth on 30 times forward free cash flow with quite sustainable free cash flow margins and quite high free cash flow margins is decent. And then if you say then opened up the name of the business and say, oh, this is Monday.com, it doesn't really seem to be that high risk, really. If we get an extreme situation where AI is literally sacking like thousands of people and we have 10 employees turn into one employee that just knows how to run the AI. If we go into an extreme scenario like that in the world, that's a risk. But yeah, other than that, I don't necessarily think that the risk is ridiculous. And I think you're right. I think Google or Microsoft would be more likely to acquire those customers and integrate them, um, or it's more about acquiring the technology and integrating it
yeah,
because
yeah.
then Google can just show it to all the customers. That's the thing. If Monday has really good customizable workflow solutions, Google have the distribution way more than Monday or Microsoft. So they acquire it, and then Monday have done all the hard work, and then they can just show it to all of the people in the Google and Microsoft ecosystem. So that actually means that if they acquire Monday, they may actually do so at a very high multiple.
Mm. Yeah, and I was just looking as well, and if this was to get acquired by someone like a Google, for example, I'm just looking at when Microsoft bought Slack, and that was a 27 billion valuation, and obviously Monday.com is a lot less than that. So if it was to get acquired, I don't think it would trigger any kind of anti-monopoly kind of situation either. So I don't think there would be any major issue from that, I think, as well.
That's really interesting.
But yeah, really good gross margins, really good balance sheet, good cash pile actually. My only criticism probably for them is that, especially with the drop that they're on, maybe they should be buying back shares from what I'm looking at here. I don't believe that they're currently buying back any shares.
Let
Have
me
I?
just see. Yeah, I think that's a good point, actually. I'm just going to see if I can see how much. I'll tell you why. I'll tell you why I think. R&D, yeah, they're just massively increasing their R&D. Their R&D went up from 156 million to 214 million last year. Maybe that's why. Again, I haven't listened to all the earnings calls. I
Hmm.
agree that yeah, they've got like 25 to 30% free cash flow margins. They could start buying back some shares. Maybe
Yeah,
it's
yeah.
just they're just going after this very aggressive approach of saying, right, let's like reinvest and really grab this AI opportunity.
Yeah, I'm just looking at the balance sheet and they've got 1.6 billion of cash, nearly 20% of the market cap in cash right there, which is a pretty good balance sheet. So I'd be using the cash up a little,
Fuck. I
you
don't know
know?
if I should be swearing, but that's actually. I'm just saying 20% of the market cap in cash makes a big difference to the valuation even further.
Yeah, because if you wanted to subtract that cash pile off the market cap, 20%, it's a big difference.
That's absolute. That's absolutely nuts.
So if we move on to our last subject of the video, what are the top three stocks you're currently looking at the moment, Henry?
Top three stocks. So, I mean, as we said, like my largest holding is actually Google right now as time of recording. We talked about Google. Uber's another really large holding of mine. I like Uber. Again, it's good steady growth at a reasonable price. They're almost hitting that 20% mark. They're only trading about 25 times forward cash flow, 25 times forward earnings, something like that. And what I like about them is their existing business is steady, but they they are in prime position to be a demand aggregator for autonomous driving without having to invest copious amounts into the R&D and underlying technology. And what I mean by that is just now when we were talking about Monday.com, we were looking at the network effect. With Uber, there's an additional moat added onto that because the network is time sensitive. So, if Uber's the market leader, autonomous driving or not, and you want to get somewhere from A to B. I mean, literally 2 days ago, I was late walking to the station, needed an Uber. Uber's also a verb, right? Like, I'm not going to go on to Lyft or some slower platform because the network effect, there's more drivers on Uber than on Lyft. So I'm more likely to get a faster Uber than on Lyft and then hence make my train. So there's like this time sensitive aspect on there of the network effect, which I really like. Dara, and I'm not going to pronounce his last name, has been a really good CEO of Uber. No one, everyone just calls him Dara. I think
I
it's
do
Dara
that
Shaggy.
so many times on my videos. Is I look at the CEO and I go, "This is the one CEO where I'm just going to say either the last name or the first name."
Sure, but as no disrespect, he's great. Everyone calls him Dara, but he's been CEO of Uber since 2017. So he's much. I know he's not the founder, but he's much more of a founder than if he'd had just come in 2021. And Uber was suffering quite a lot in 2017. They obviously led Uber through IPO, which was in 2019. So Uber a really interesting business. Good risk reward, I'd say. And that's the thing is that like if Tesla takes 100% of the autonomous driving market just like that, that's a headwind for Uber, absolutely. But if you get all of these companies coming in and taking 10% market share, a few percent to Waymo, a few percent to all the others, I think Waymo will get more than a few percent, but I think they'll be one of the leaders. But that is where Uber benefits because they will all need Uber, and it'll be a gradual transition. So I like Uber, and we said, I mean, sticking on autonomous driving, I won't talk much about it now, but Aurora do autonomous trucking,
Okay, yeah.
and there's a big video on Aurora on my channel. But that's a very spicy one because they're pre-revenue. You are investing in an idea. It's just that the size of the industry and how far they are ahead that makes me interested. But that's a small holding. And another company I bought recently was Confluent. And they do data streaming for basically that's going to be really useful in agentic AI. So as I was saying earlier, as we have AI that actually interacts with us and learns off real-time input. So obviously most large language models at the moment, they're batch trained. So they get trained on some data. Eventually they get retrained on more data. Eventually they get retrained on more data. I think there's going to be more real-time use cases for AI and Confluence kind of that back office pipe that helps data flow, or they're the enterprise solution for that. A Kafka is the open source pipe, and there are a couple of others, but the founders of Kafka also founded Confluent to basically help enterprises use Kafka. Kafka is quite difficult to deploy if you don't have a massive team. So large companies like Uber build this data pipeline from the ground up. A lot of companies in the future will need to use Confluent. That's kind of the thesis there. And I've got videos on my channel about all of those. But let me know if you've got any questions on that, Jacob, or also which stocks you're looking at.
Yeah, I think Uber is probably the one that is probably most interesting to me. Matty is on the private group. He's a big fan of Uber, and he was at me to try buy it about a year ago when it was about $60, and maybe should have got in then. With Uber, I was kind of sleeping a little bit when they were doing. I thought it was going to be a bit more of a battle between like them and Lyft, but Uber seems to be the dominant player now, and obviously, like we were saying there, they got that catchphrase, Uber it. And I guess the thing with Uber is that it's just a lot more worldwide now than Lyft. If you go to Paris, you get that Uber. You go to Barcelona, you get Uber, and that's the benefit I guess Uber has now is it's that kind of expansion, so you get more used to just straight away going to Uber now, and that's been a real big benefit for it.
That's actually true. I've just thought of something. So America's okay, on the whole has terrible public transport, right? America is still like Uber makes more revenue from America than any other country. However, Uber's a very global company, right? They don't make most of their revenue in America, but America's number one. So Americans don't take a lot of public transport. So when Americans travel, they're typically going to choose Uber. The thing is about Lyft is big in America, Bolt is quite big in Europe, but when Americans go on holiday, okay, maybe some of them will use public transport around Barcelona, but if you just need to get from A to B, we all tend to take a lot of Ubers when we're on holiday, particularly if we're going out in the evenings and that kind of stuff. They'll just be like, boom, Uber, because Lyft is either not in the country, in Europe or somewhere else, or is very slow. Because there's not many demand aggregation is just much slower. And you're right, Uber's just been a verb. Like Google it.
Yeah.
Instead of getting a temporary holiday accommodation, we're getting Airbnb. It's become one of those verbs.
Yeah, and I think maybe one of the things that's been overhanging Uber is this kind of if all driverless cars comes a big thing, but now they've got this partnership with Google and Waymo. I think that's kind of covered that issue as well a little bit in the short term, and that's probably going to be a good benefit for them in the longer term.
Mm. Yeah, I think it's good that they've got a diverse partnership with
Mm.
them. And my point is that Waymo, they are building their own app. And yeah, like autonomous driving enthusiasts are going to go on that app. But when it actually comes to marketing the masses, Uber's got the distribution on that. And eventually at scale, Waymo are going to realize, oh, we're going to go onto Uber. And Uber can advertise like, oh, you can take this car or you can take the full self-driving car. Some people are going to take the full self-driving car because it's cool. But at scale, it's going to be cheaper. Because when you order an Uber, revenue is about 30% of bookings. So 70% of the fee goes to the driver. Uber take a 30% cut. What does that mean? Is in the taxi business or in the rideshare business, at least half of the cost is the driver. So that cost is removed. So hence at scale, autonomous cars are cheaper. So hence, when Uber says, "Oh, you're getting from A to B, you're going to get a driver who's a person for like $50, or you're going to get a self-driving car for like $30 or $25," and they realize, okay, autonomous driving cars are safer. If it's late at night, the drivers, there's no risk of a driver being creepy. Not that many of them are, but you're always like, you're thinking about that, particularly if you're a woman. And there's a lot of advantages to it.
Yeah, and I think if this self-driving car, taxis do take off, I think Google and Uber will work very well together because I don't think Google would like to set up their own app and they just go straight, directly to someone like an Uber who already have the customers there waiting for them. They put the driverless cars out on the Uber app and then Google basically gets all that customer base straight away. Uber just takes a cut for basically renting the app out, and for Uber, they don't have to do all this hiring with these drivers. They don't have any of these horror stories anymore with these drivers because obviously the driverless cars. And both, Google and Uber would win from the situation. Google has the customers provided to them by Uber, already waiting for them, and Uber basically just takes the cut for renting out their app out to them, basically.
Absolutely. And I think the more that scenario is even more likely if other autonomous driving players start to catch up to Waymo, which they are starting to do. Like there are a lot of companies that are testing in different cities. If Waymo was like 10 years ahead of everyone else, Waymo were ahead. But if they were decades ahead of everyone else, they may say, okay, it's going to be easy enough to build that demand aggregator. Uber have got hundreds of millions of monthly active users, or I think it's 130 million or something like that. They do billions of trips a year. So if Google were like 10 years ahead, then they could afford to do that. If they're not 10 years ahead, and I don't think they are nearly 10 years ahead because these other companies are starting to come up now, they're not going to risk that because they've done these self-driving cars. They want to get them out. They want to get them making revenue. They want to get their name out there. Uber's advertising for them. You know what I'm saying? Uber's actually advertising their vehicles. So Uber's going to be like a marketplace for full
Yeah.
self-driving car companies to then provide their service.
Yeah, and onto my top three stocks, I would say that the ones that I like as my biggest holdings right now are probably Mercado Libre. AMD and Google. Obviously, we've already talked about a lot about AMD and Google already. Into stocks that I'm really interested in at the moment. It's hard to find value at the moment, but the two that probably stand out to me are the local at the moment and Adobe. I don't know if Adobe is one that you're interested in.
Amazing. Wow.
Is
Okay.
is
So, okay, let's start with like your big three. As we said, we talked about Alphabet. We're both big holders of Alphabet. We're both big holders of Mercado Libre. I think that's fantastic, and I agree with you. I think there's really good value in South America. And I looked at D Local this morning. You could tell me exactly what happened in their business because they had some slow growth, but it was saying that their forecasted revenue growth is now back up to 36%. And
mm,
obviously, we know the thesis in South America for payments. A lot of people still don't have bank accounts. There's a massive demand for the payment infrastructure.
mhm.
Things are changing very, very fast there. So I'm really interested to hear a lot more about dLocal because you know me, I'm a growth man, and I see very fast growth there.
Yeah, yeah, and it's a pretty good valuation. Yeah, we do local. I'll try sum it up in a few minutes, but honestly, there's been so much drama. It's more than an episode of Coronation Street with it, so I'll try my best to sum it up in a few minutes. But yeah, the local I've been in for about a year. Originally, I was underwater for a while, and then recently just gone back into the positive after its recent jump off earnings, which were really incredible earnings to be fair from it. Yeah, basically the drop happened because basically it had a perfect storm of everything that went wrong for it. It had a big impact. It had the issues that were happening with Argentina, if you're aware what was happening in Argentina in the time. And as well as that, it had a customer that did big repricing from it, and basically all those three things basically just hit it all at once, and it got absolutely whacked. That was about a year ago now, and basically now it's moved on from all those impacts hitting it a year ago. So now it's got really easy comps, and in fact all those big headwinds for it have actually turned into big tailwinds for it, and that's why now you're seeing those issues kind of going out with the business, and now you're seeing that big surge in growth. And as we saw with the recent earnings, the company's growing at 30+% at the moment, and yet with a cracking balance sheet, high profit margins, high growth, and even though it's been performing well, I'd actually look at the valuation, and even though it's had a bit of a jump at the moment, I still don't think that the valuation is pretty fairly reflecting the performance of the business here.
Hmm. Yeah, looking at it on a snapshot, I think it looks pretty cheap right now. Pretty good value. Is there any overlap with Mercado Pago? I know it's like a massive industry and it's also a massive population, but are they can they complement each other?
Yeah, not really, because we do local. It's actually like managing the payments. It's actually taking on the payments and converting the whatever the current local currency is into dollars. So that for the obviously these US companies, and then obviously managing the payments, taking on the risk. Also, a bit of fraud protection as well to when the payments are coming in as well and managing it. So yeah, it's different kind of company really towards the likes of New Holdings and Mercado Pago.
Wow. Yeah, I mean it's a big market and I can still see D Local at 3.7 billion market cap. I like it from a valuation perspective, and I can see as well they're quite optimized on the bottom line, or they're at least making good money on the bottom line. So I can see that fits in well. 19 forward PE, 22 forward free cash flow. I actually really like this. I'm going to add it to my watch list.
Yeah, yeah, it's definitely really interesting, and it's got a cracking balance sheet as well, and those high profit margins, like you were saying, and they generate that amount of profitability, that much of profitability. They're buying shares back like crazy as well, and they actually at the moment have bought that many shares back that the management team actually came out and said, look, we can't buy any more shares back because it's going to make our stock, super well, a lack of liquidity. So we can't do any more of a share buyback at the moment. So the only other option we have to kind of attract you in is to do a dividend. So they actually in the last year actually paid out a special dividend, and I think the special dividend was a yield of over 5%, which is just absolutely incredible.
Wow, that's amazing. It's always good to see when they're very confident to buy back a lot of shares, because obviously it's telling you that the internal management that know the company better than anybody is confident it's a good time to buy back.
No
And
problems.
I definitely agree with you that Adobe is a good value right now.
Oh
It's
wow,
you
I
know
was
I
expecting you to not be a Adobe fan.
Well, it's funny. Like I did have a small holding in Adobe that I bought in January, because it's a classic what you were describing, like good value. Is Adobe going anywhere? Probably not. It is a really good value, right? Like 17 forward PE, 17 forward free cash flow, and they're forecasted to grow at 9.6 on the top line. And last year they grew at 10.8, but the year before that they grew 10.2. So they had a re-acceleration of revenue last year. So I like that. Um, Quantitatively, it looks lovely, and I think I know that they had some really impressive AI stuff a few years ago with Adobe Firefly. But I'd just be interested to know your thoughts on if you think that they if you think they've got enough. Like they clearly have good data for AI creative stuff. They've clearly got great distribution. It's just a question of, in the long run, if the companies with massively powerful AI, like what Google's been able to do, will start to eat away at Adobe's market.
Yeah, well, obviously, this one is another one that is, is it going to get disrupted by AI? And it's kind of got Google vibes written all over it all again, where the market's kind of thrown it out, doesn't want it. And obviously now they're realizing with Google that actually there might be something here with the AI business, and I think that's going to be the same with Adobe. Really, I think they got off to a bad start, a bit like Google. They brought the Firefly out, and that could have been, a bit better than what it was. But ultimately, I look at someone like Adobe, and even if they aren't got the not got the best products right now, who do you probably want to back in this space? It's Adobe. How much money they're going to have in the ability to throw off just to throw at this AI product to try and make the best in class. That's probably the one that you'd probably want to be backing, wouldn't you? The one with the big money to make the best AI projects that they could make available for them. And I think overall, people keep brushing off saying, "Oh, we don't need these editing programs," but I think with someone like Adobe, I think the best of both worlds here with this AI and editing programs is that you have your Photoshop, but you have your AI in the Photoshop, because AI is not going to do everything exactly that how you want it to do it, and you want to do it yourself manually sometimes, and it's going to take AI still many more years to get probably close to the perfect way that you wanted it. I think it's eventually going to get tied into where we have the Photoshop, but you have the AI platform working alongside it.
That's very true. That's very true. And you're right. They've done it before. They've done it before. They've got the distribution. And I think that also, I don't know the management team very well. I know that they've had the same CEO since 2007, so he's been there for a long time, which could be a blessing or a curse. But I certainly don't think they're just going to kind of be chillax about AI, because it's a two-sided coin with something like Adobe. If they win, then they win, but at the same time, there's also disruption risk. So they've got massive potential tailwinds if they get it right, because they've already got the distribution and all the legacy customers, and they've actually had a really good history of always improving their product. It's just the flip side of that is like, yeah, if they don't, then they obviously understand that there's disruption. And I just like the fact that the growth rate has not really slowed down that much. It's slower compared to pre-pandemic, but they're much larger. Like they're still kind of, this is the thing, is they're ticking along at 10% growth rate, but they're ticking along at 10% growth rate when the multiples are probably lower than they should be. So that
Mm.
means, like, yeah, you're going to get higher multiples plus a 10% growth rate. Every time they grow 10% and the stock doesn't move, those multiples are getting lower. So it's getting better and better value. So yeah, I could absolutely see why that works in the portfolio.
Cool.
I think that's
We have
everything,
definitely
unless
gone
you've got
over the
anything
hour
else to
mark.
add. What's that?
I said we've definitely gone over the hour mark.
Only a little bit. Two hour mark. Well, I just if anyone's still listening, that's fantastic, and I hope that you've gained significant insight from Jacob's wisdom and my thoughts as well. And yeah, Jacob, it's really been a pleasure.
Yeah, it's been great. I'll make sure I leave a link to your YouTube channel in the comment section and the description. So if you could go give Henry a sub, that would be absolutely amazing.
Thank you. And obviously, likewise to Jacob. It'd be interesting to see. Leave a comment if you were a viewer of both channels before the podcast. I'll be interested to see if like we had any mutual subscribers or mutual like viewers before this.
Yeah.
And yeah, let us know if you liked it and what you'd like to see, because Jacob and I, if we said if this went well, we'd love to do another one. So just let us know what you'd like to see more of, and any feedback would be much appreciated.
Sounds great. Thanks for watching, guys.
Thanks again, Jacob. Enjoy the rest of your day.